presentation really deals with the challenges you all face as federal employees, and we're going to be trying to bring those together. There's a lot of things that are different about federal employees, right? One is you have a pension, you have typically going to have Social Security, right? And then you also have your thrift savings plan. There's some mistakes that happen for federal employees, especially around the allocation of their accounts, what they think they're going to be using first, if let's say they delay Social Security and decisions around that, and then ultimately taxes. I think there's a big misconception on how you're going to be taxed in retirement. And I think that what we're going to try to do today is get some of that private sector education that you've been given as a federal employee kind of to the side and have you think a little bit differently on how to strategize your retirement around tax. So we'll end with that today. And then lastly, we'll end with a slide that gives you the opportunity to schedule a one-on-one meeting with us. If some of these things are just, you need a little bit more clarity or you need your own numbers dialed into this. So let's begin. I'm going to do a quick introduction about myself. I am local to the Maryland area. I grew up in Rockville, attended Towson undergrad, finished up at Georgetown. I've been in the industry for 18 years, working solely with federal employees for about 15 of those. I'm also a certified financial planner and double up as a chartered federal employee benefit consultant. So that's a little bit about myself. And of course, RepFed is about blending in strategy, financial strategy, with your federal understanding and your benefits. So that's really what today is going to be about. So let's address some of the risks that we have in retirement, right? One is we're living longer, okay? So the chances of someone living at 90 years old is a lot higher than it was just a couple decades ago. Inflation is now on the radar as a much bigger issue than really what it was in the past. Inflation was lingering around 2.5%. Since COVID, we've had spikes to inflation. The new norm will probably be something around a 3% rate. And at that rate, that will burn a lot of your purchasing power in retirement if your investments are not allocated properly. So a lot of people believe that when they're retiring, essentially, their investment period is almost over. Like I've seen people just switch completely to the G fund right before retirement because they don't want to lose any money. But okay, so what's going to happen through retirement? Are you going to keep up with inflation? Most likely not. And if you're all in the G fund. So we got to talk about some of the downsides of the G fund today and how those pertain to retirees. Lastly, market performance, volatility causes people to do some bad things at inopportune times. And then Social Security is also a concern just because it's underfunded. I'm going to talk a little bit about that today. And then taxes. We strongly believe that taxes will be going up in the future. In fact, if nothing is done to the current tax code, it is supposed to reset in 2026, which means that the old tax rates that we had prior to the 2018 changes come back into effect. I'm going to show you how that would kind of change your retirement path and what are the bogeys around that for you all. Okay, so we just got a boatload of questions. I see like 19 of them, but it's all around audio. Okay, so let me at least address questions really quickly. Is you may have some questions that come in. What I'm going to try to do is save the questions to the end. I'll do an extended period, 15 to 20 minutes if needed of Q&A. So be sure to hang on for that. It's not that I'm ignoring your questions. It's just I'm trying to get through this material within the slated time slot so that you guys can get out and get back to work if you need to. Lastly, if you're looking for the slides or a recording, those will be sent to you. Those will automatically be sent about within 24 hours of the end of this presentation. The other thing that I want to mention also is closed caption. If you need closed caption, there's a tool on this bar here for Zoom where you can toggle on that closed caption. Okay, so let's get going. Let's start off with what makes you guys unique as federal employees. Well, of course, it's your pension. So your pension is going to be derived on essentially when you were born, will drive when your minimum retirement age is. So depending on, these different months from 55 to 57, you're going to have that as your minimum retirement age. But the question is, does everyone get to retire at their minimum retirement age? No, because if you don't have 30 years of service by your minimum retirement age, you're considered leaving early. So then it's 60 with 20 years or with 60 with 5 years at age 62. Now, when it comes to the sweet spot of retirement for federal employees, where is that? Well, if you notice, right, if you're a FERS participant or FERS annuitant, right, if you retire under the age of 62 or 62 with less than 20 years of service, the factor of your pension is 1% times the years of service times your I3 average salary. All right. However, if you hold on to the age of 62 and have at least 20 years of service, it's a 1.1% factor. Now, that may sound incidental, but really what that does is it actually brings forth about a 10% jump to your pension at that moment. So if someone's on the cusp of, let's say, making a decision to retire at 60 or 62 and they have that 20 years of service, essentially they're going to get a over 12% increase to their pension just in those 2 years of waiting till from 60 to 62. Why? Because the factor is going to change. Not only are they going to work those 2 years, but the factor of what is being calculated is going to change by 1.1, which is essentially a 10% bonus across the board. So clients that come in and we do what we call retirement roadmaps for them, and they're looking for advice on when they should retire. A lot of times we try to get that client to hang on until 62 if that's going to get them that bonus. Now, we obviously know that everyone's different, everyone's situation's different. Folks that can retire at their minimum retirement age may not want to wait that long, and that's okay too. As long as you guys have kind of a plan B for your income, because one thing to think about too is even if you retire at 57 years old with your 30 years, let's say you've achieved that, you're not going to have a cost of living adjustment on your pension until 62. So that's a downside of the FERS pension system. The CSRS old system began immediately as soon as you retired, and you could retire as early as 55 there. And that cost of living adjustment began immediately. Not only did it begin immediately, the old system, but it also paid you exactly what the cost of living increase was on the CPI index, which is essentially the inflation index. Okay. The first annuity system does not do that. Okay. So essentially, right, if we're going to be up in this category, which we believe we most likely will for the indefinite future, right, of 3%, you're going to get 2% every year in that scenario. So is that a big deal? Well, not in your first couple years, but fast forward 10 years down the line, right? 20 years down the line into your retirement, now all of a sudden you have 20% less purchasing power coming from a really core piece of your income. So that is what you need to be aware of as a federal retiree, is that you're going to be needing more and more of your TSP every single year of retirement because of this situation. So your withdrawals on your TSP is going to kind of look like this. It's not going to be flat. All right. So a lot of people do like a back of the envelope calculation and they're like, all right, cool. My expenses are this, my pension is this, my social security is this. So therefore I'll need this every single year. Well, guess what? No, that's not the true calculation. Your calculation's actually going to be an upwards moving number like this drawing I just made right down there. So keep that in mind. Okay. So again, this is kind of a crash course to everything retirement. So we've got to talk about social. And what I want you to know about social is that Social Security actually doesn't start paying you out your full benefit until your full retirement age on Social Security, which you're seeing up here in this chart. So for most people, that's going to be somewhere between 66 and 67. A lot of people, that's going to be, moving forward, 67. So if you're drawing Social Security before that, yes, you can do that. Here's a chart that depicts if you, for someone that was their full retirement age for Social Security was 67. This depicts essentially the penalty that you're getting on your income by drawing that earlier. So as you notice, right, if you draw that and you can do that as early as 62, you're going to have a 30% penalty. Now, it improves by 5% each year and then starts improving by 6.7% as you start getting to your full retirement age. Then, if you can wait, it starts improving by 8% each year from there forth. Now, why is it helpful to wait for your full retirement age from social? One is more income. Two is there's no earnings limitation. So keep that in mind, guys, right? If you draw Social Security before your full retirement age and you go and earn income as wages or self-employment income, not passive income from retirement or rental income, right? Or investment income, but earned income, there's an earnings limitation. You're going to lose some of that Social Security. Two, your spousal benefits, like if something is your spouse's benefit, if something happens to you and they need a survivor benefit, that is tied to your Social Security. So again, if you're stunting those by taking those early, it's going to diminish that income to your spouse as well. So these are just some kind of easy things to pick on. Obviously, you can also see the difference in income over time, but normally someone's going to raise their hand and say, well, Neil, that's all cool and all, but what you're telling me is to delay. But like, what happens if I don't even live long enough to see the benefit of that wait to draw that income? So this is a chart that we drew out. It's not the best chart, right? But we put 78 and 83 on that board so that you could see when the break-even ages are. So essentially what this is looking at, right, is if you draw at 67 and you draw at 62, right, the smaller payment here at 62 would start sooner. Then the delayed payment at 67, right, would be a larger payment than the 62 and would finally catch up at 78. So the question there is, okay, well, are you going to live past 78? Most people probably are. So again, we like the idea of waiting to draw Social Security. Now, there's something to be said for at least interest rates are higher. So if you took Social Security at 62 and you stash that in a bank account, you could make maybe somewhere around 4%, if you use a treasury type of or a money market. But that wasn't the case a couple of years ago. So we were definitely telling people to hold off on social. But it's usually going to work out into your favor to hold off and wait. But again, every scenario is different. Now, of course, waiting to age 83, waiting to break even to age 83, drawing Social Security at 70, isn't for everybody. And we don't see a lot of folks do that, but we do see folks do that for reasons that aren't tied to more income. So the reason that we would see someone wait until drawing Social Security until 70 is not because they're trying to increase their Social Security. It's that they're trying to keep their tax rate artificially low in retirement so that they can begin pulling money out of their thrift savings plan at a low tax rate and begin pumping that over into Roth. So that's a technique called a Roth conversion. So that's the reason you'll see someone delay to 70, because they're going to keep their income artificially low during those periods where they're converting over to Roth, dump as much money into that Roth, shifting pre-tax to after tax. and grab that low tax rate while they're shifting over. That's typically the only reason we see that. So keep that in mind. That's a strategy, and we're going to actually talk about that strategy in more detail here as the presentation goes on. So, what is the problem with social, and what are the things that you need to think about when you're thinking about delaying social and those things? Is one, it could run out of money. So, we talk about it running out of money. Do we mean that like you wouldn't have any social security? No. Essentially, what it means is that um, there is a trust fund, and that trust fund is expected to go dry by 2034, which means that what that trust fund is supplying, which is around 25% of the benefit amount, 75 is coming from people that are working, right? That 25% would not be there. So when you are doing your own calculations for retirement, that also needs to be a worst case scenario to your retirement income. What if I didn't have 25% of my Social Security income? Okay. So when you're doing that back of the envelope calculation or something on that looks like this little manila pad, right? You need different scenarios. You can't just have the most optimal one, right? You need inflation in there. You need your pension not keeping up with COLA, and you need a scenario maybe that doesn't have your full Social Security in there as well, right? Foolproof your retirement plan is really the best way to go. So, all right, we've covered two big core pieces of being a federal employee, which is your social and your pension. Hopefully, you learned something new from those two. We're going to try to build on that and talk a little bit about the TSP. So, the TSP is that third stool. You've heard this probably before, right? Three legs of this stool: pension, social, TSP. So I'm not going to bore you with explaining the basics of the TSP right now. I go more in depth on the TSP during our TSP presentation, but it's good for you to know at least what these funds are, right? And, exactly what they do. When you talk about US investments of equity investments, stock investments, we're talking about the C and the S. When we talk about international, we're talking about the I. And then when we talk about your two safest choices are the G and F. Now, keep in mind that G fund, if you look at your statement, has literally turned into cash. It used to be described as a bond, but it isn't a bond. It's literally nothing different than a savings account at this point. Okay. That interest rate really hasn't even kept up with, I would say, the increases to interest rates in some of these higher powered savings accounts. The F fund, though, is a bond index. And generally, that's going to be safer than any of the three choices below. It's going to invest in mostly treasuries. And there are some cases where the F fund really struggles, and that was in the last couple of years. When interest rates are on the rise, the F fund has a really difficult time in that scenario and often goes negative. So the F fund just went through its worst period on record since the creation of the index, which was like back in the 60s or 50s or something. So that's how bad the environment was for the F fund, because we went from a 0% interest on the Fed funds rate all the way up to almost 5.5. Now, do we think that the environment's changing for the F fund? Yes, we do. We'll talk about that here in a second. But life cycle funds, that's kind of your last choice. That's a fund that's going to essentially mix all these five together, and it's going to change that allocation as you get closer to retirement. So again, not trying to bore you with the basics because maybe a lot of you know. So let's get to another slide, which actually gives you a little bit more information in a visual way that you may not have seen before. So considering that every single one of your TSP choices is an index, and it's an index that exists as an investment in the outside world, we can track what the risk level of these investments have been and the return. So one way that portfolio managers make decisions on their portfolios is to look at what is the volatility of this certain fund or index, or even stock for that matter, versus how good it's done. So this is essentially that chart. the further over you get onto the right side here, the more risk and volatility that fund has. So when we look at what is the riskiest fund in the TSP, well, it's the S fund. The S fund invests in more smaller, obscure companies in the US market. It's about a 2 to 3,000 company index that it's tracking, more so 3,000. So that in itself is going to make that index a little bit more volatile because that index also tracks small to mid companies. It's not tracking large companies, large cap companies. The C fund is what's tracking US large cap companies, and that's the S&P 500. That is by far the best stock fund of the last 10 years, no doubt. Look at the performance and look at the fact that it's the lowest volatility amongst those three funds. Now, the concern, which we're going to talk about in a second, about the C fund is it's highly concentrated and weighted to about 7 companies, which are the Magnificent Seven now. It's no longer FANG, it's Magnificent Seven because it's been, we've added a couple other stocks to the FANG acronym. But that index now, those 7 companies comprise 30% of that entire index. Okay. So that's the concern there. I fund, take a look at that fund. I mean, geez Louise, that fund has been quite a dog. I mean, it is taking high risk and it is returning much, much less than any of those US indexes. So to me, listen, it's not that iFund should be avoided, but it sure should be downweighted in a portfolio until it proves that it can actually perform with the level of volatility and risk that it's actually taking. I mean, to get half of the US market's return, but have just as much risk. And when the US market drops 30 or 40%, the iFund drops just as much or more, and you're not even getting compensated for that risk. That to me is a message that says, hey, I shouldn't have a large allocation in that fund at the moment. Now, we are warming up to international, and I'm going to talk about why in a second, but it still is something that is kind of in the doghouse for us, but we're releasing that out of that doghouse recently because of the valuations of US companies. Now, notice all at the bottom of the scale here, we've got the G and the F. The F, horrible, compared to the G actually, because of these last couple of years, really tough times for that F fund. But we think better times are on the horizon. So let's talk about these funds individually. I don't want to get too stuck on every single one. But here's our concern about the G. If you look at the G fund and you look at the inflation adjusted returns of the G fund over time, yes, the G fund was good in the 80s and 90s, but that is not today. Look at the G fund's return really through the turn of the century here, right? 2000. Barely ever in the last, call it 20 years, has that fund actually really made you anything over top of inflation. And a lot of times it's been negative. The sad part is this is a chart that I was able to actually get off the internet. It stops at 2020. But what I will tell you is 2021 and 2024, if we were to continue drawing that chart, is like down in there. I mean, it actually would be even further. Inflation was at like 9%, and the G fund was only given 2-3% during that time. So like it's starting to come back, but you're still going to be somewhere in this break even or at best. So when you rewind the tape just back to the last 20 years, let's say that's the starting point to here, like what is that fund really giving you in terms of risk adjusted returns? Is it a long-term strategy? Really, it's not. It's a short-term strategy for folks that are getting close to retirement, that want some money that isn't going to move around, that they're going to be using within the next, let's say, 3 to 5 years. Okay. I'm going to talk about that and how to allocate your account based on strategy and actually life events versus just, an allocation that's just kind of made up. All right. So F fund. We talked about the struggles of the F fund. We talked about how it's been so awful over the last 3 years. Most people just want to take this fund and ditch it and probably replace it with G. If they rode the G during this time of turmoil for the F fund for the last 3 years, they did great. Okay. But now it's really time to use that F fund again. If you're really strongly invested in G for your safe investments, right? You really aren't you really need to consider that F fund again because now that the F now that the Fed is done raising rates, at least that we think, and now the at least tipped off, hey, we might be cutting this year. This F fund should rally. If at worst, it should provide with a much better interest rate than the G fund. But if the Fed does cut, just as the Fed raising interest rates hurt the F fund, if the Federal Reserve, cuts, it will the F fund on top of it having a higher interest rate. So if you don't believe me, look at the history. The F fund does very well once the Federal Reserve pauses. Why? Because once they pause, they're typically the next move is going to be cutting, right? And bonds rally in a cutting environment. Okay, the average return on a 3 year basis on bonds is about 10% per year in that scenario. Okay. I'm not saying that's going to happen again this time, but because I don't think you're going to see the Fed cut drastically. So maybe you get, 4% interest plus another percent appreciation. That's five. That's gonna beat your G fund. Yes, there's some volatility there, but we are more constructive on that. All right. So I just showed you why the C fund crushed all other stock investments over the last decade for you guys. And if you use the C fund, pat yourself on the back. In fact, if you use the C fund completely, pat yourself on the back. But understand there's some concerns brewing in the C fund because of the valuations that we have from the 7 companies that have such a strong weighting in the S&P 500. Look at the valuations of the top 7 companies. They're they're at 50. So what does that mean? That means that you're paying $50 for every $1 of profit that these companies make. Look at the other 493 companies. They're at around 19, 18 P ratio. Okay, just understand that the historical average of the S&P 500 in the last couple decades, the P ratio has been around 16, 17. Okay. So when you take the S&P 500, the 7, and then you blend that with the rest of the 493 companies, the P ratio is above 20. That is approaching a valuation that usually throughout history has had a correction. You get a correction in the market because these companies are just getting overly valued. So that's our concern is that you're getting inertia on that C fund. Yes, you are, but you're only getting that inertia from those 7 companies. And if something happens to the leadership there in that 7, we think that C fund is vulnerable for a pullback. Okay. I'm not saying to get out of it. I mean, listen, you don't have many choices here. You get 5 choices. So if we call the L funds also choices, but again, the L funds are using these 5 funds. So there's no way that you can avoid the C fund, and you should have the C fund potentially as your strongest holding. But if your C fund was your only stock holding, it's now time to diversify a little bit because of those valuation concerns. Okay. And that's where we're warming up on international. International has been horrible for the last 10 years. But what we like about international as a whole is that the valuation is around 12 PE ratio versus 20 on the US markets. Okay. So it's now more attractively valued. And every once in a while, you'll have international actually lead for several years because these kind of valuations get upside down. Now, what we don't like about your iFund, just to be candid, is the fact when it comes to international, It's not what you own, it's what you don't own. And the problem with the iFund is simply that it's an index. It piles in all these international companies from Europe and across the Far East. And some of those companies just aren't good. They're part of the index, but it's not good. I'm not here to promote active management, but I'm a big believer that when you are in the international space and you're investing in international, you or almost need a manager within that fund that's going to dump out those bad international companies. Okay, that's not a plug anyway for active management on international because you don't have the capacity to do that in your iFund. But I just want to at least say my insecurity about the iFund, even though the valuations are really starting to look attractive. Okay, so where does this all lead us? Well, we're still in what we call a recession red zone. The reason that we're in this recession red zone is there's several indicators, and a group called the Conference Board tracks these indicators, and they've been doing it since the 70s. And every time that we get into a flashing kind of red scenario where we're underneath that 0% line, we've had a recession. So these Conference Board indicators have been pretty accurate. And right now we're in a red zone. What does that mean to you all? Like, oh, sure, are you telling me to get out of my stocks? No, we're not. But what we're just trying to say is do not be taking excessive risks in your TSP. Really try to get into an area where the risk level is appropriate for your age, for your proximity to retirement. Because even though things looked okay in 2006 and 2007 until they weren't, right? And the same indicator, okay, that flash for the global crisis is flashing today, okay? Could this time be different? Sure. There's so many factors here at play that are really hard to relate. Like we printed a ton of money during COVID, right? So there's cash still in the system and people are using that money, right? And people refinance their mortgage to low interest rates, so they're not saddled with a lot of debt there. So could there be different things at play that this leading indicator actually is wrong here? Sure. But with the odds of how accurate it's been, I will tell you, just be careful if you're outside of if you're over your skis in terms of your risk on your TSP. If you're about to retire and you've kept the foot on the throttle and you're pumping, the C fund, S fund through, and you haven't changed your allocation, now's the time to reassess. The market just went back, if I'm not mistaken, most of those index went back to their all-time highs. You're getting a pretty good time to reallocate here. Okay. And just so we're clear too, is September is the worst performing month in a calendar year in the stock market. Guess what the second worst performing month is? February. Okay. So just be sensible about your TSP allocation. Do not be pushing the limit here because we do see that when uh, cycles peak, right? Industrial production, this is GDP, this is what basically measures a recession. The market usually sniffs that out prior to. So if you think, oh, I'm going to pull or not pull, I'm going to change my allocation to be a little bit more safeguarded. Um, Once I see the US start to go into recession, forget that. The market usually sees that coming 9 months or 8 months by this chart in advance of that actual, like, that cycle peaking. And then by the time we're in a recession, there's more drop to have, right? Now, it will finally start to recover, but that could take a while. So, this is -8 months, and then over here, that's 16 months. On average, you're looking about 2 years in that scenario where you could break even on that. And if you're close to retirement, that could jeopardize you. Now, again, you're seeing the data here for everybody else. So if you're mid-career or early career, should you be trying to time this quote unquote maybe recession. No, you should forget that I even told you this. Leave your allocation and let that chug up with stocks. And if it does break down, okay, you got a 2 year kind of period where your money is going south, but you're gonna have to wait that out. Okay. So don't try to play games with the stock market. Usually the stock market's going to win. But I'm just trying to tell you what we see. Okay. And just for those clients that are close to retirement or in retirement, those are the clients that we're being a little bit more cautious with. Okay. So here's some practical strategies for investors. Stick to these, and you're going to be, in a good spot when it comes to investing your money. Don't engage kind of in that fear, that in flight stage by just dumping out. Even if I've told you, hey, we're in that red zone, tune that out if you're not getting close to retirement. All right, so let's talk a little bit about retirement withdrawal strategies. Keep in mind when you retire, right, your funds, your money isn't going to be there for you right away. What's going to be there right for you the first is your annual leave check. You're going to get your annual leave as a lump sum. That money will come within the probably 1 week. We put a little bit longer here just to kind of cover our own, you know, and that's why we're putting the 4 weeks, but it's going to be coming pretty quick. So, 4 to 8 weeks is when you get access to your TSP withdrawals. Usually that's going to be on the earlier side of that, 4 weeks. But remember, your TSP pauses for at least a month. You can't withdraw once you retire. So keep that in mind. Next is pension. Your pension doesn't begin right away. Have you heard this from like, in the grapevine? It doesn't begin right away. There's going to be weeks where you don't have that income coming in. And what's going to happen within the first 4 to 12 weeks is it's not going to actually be your real pension. It's going to be what's called interim pension. And after that period, 3 to 6 months within your retirement, that's when your full pension will be calculated and will begin. And anything that was short, right, will be given to you at that point in time. So just keep that in mind when you're thinking about retirement or getting close to retirement, is that income will take a little bit time to get to you. Now, when we talk about investing, and we talk about investing for someone that's close to or in retirement, we think that the best way to conceptualize how you invest your money is by thinking of this in buckets. So imagine, right, that there was 3 buckets, and these buckets provided for short term, okay, midterm, and long term. Let's say that short term bucket is 3 to 5 years. Let's say that midterm bucket is going to be 3 to 6 or 7 years, and then long term is going to be 7+ years out, right? If you aren't using money within your first within 3 to 5 years, why would you have a lot of money in this safe and liquid bucket, right? Why would you be keeping a strong allocation of G? You're probably doing that because you're trying to time the market, which we've time and time again been humbled so greatly by this market that even the pros don't know when this is going to go up or down, to be honest with you. So you don't really want to keep a strong allocation here, right? So when you think about this bucket strategy, okay, the short-term bucket should be filled with assets in fixed income like G fund for the next 3 years, right? Anything that you're going to use in the next 3 years, sure, do that. Fill that with into the short-term bucket. If you want to be even safer, make it 5 years. So let's say you're going to retire next year, and you're going to use $30,000 of your TSP over the next 5 years. Put 150,000 in your G fund. Okay. Now you know whatever the market does to the rest, to that midterm and long-term bucket, you aren't even worried about it. That long-term bucket right here, right, could completely go down. So if we go back, this long-term bucket could go down. But if you got 5 years worth of cash here, right, in something safe, and then you've got another 2 to 3 years, maybe in something more midterm, right? A little more conservative. We could think of like things like um, income investments. When we look outside of TSP, there's these hybrid income investments where they use different bonds, multi-sector bonds, preferred securities, things like that, right? That are going to be more midterm or just like a balanced fund maybe there. So those would be kind of an example of a midterm. You don't really truly have a midterm inside your TSP. So that's why I kind of wanted to make that clear. But you do have your short term and you do have your long term buckets. Now, how are you going to be withdrawing in retirement? There's a lot of confusion around this. So many people come to me and they say, well, I invest in my TSP conservatively, put a lot in my G fund, but outside of my TSP, I have a lot of money invested in stocks. And I say, geez, don't you know that you're going to use your non-retirement assets first in retirement? And they're like, no, I didn't. Why would you use your non-retirement assets first? Because your non-retirement assets do not tax you as income. So when you make a withdrawal from, let's say, a non-retirement account, let's say your savings account, that doesn't get treated as income. If you have to sell a stock, yeah, you pay capital gains. Those are more friendly. Normally you pay 15% capital gains tax rate. Whereas if you make a withdrawal from your retirement assets first, that's going to be treated as income. And a lot of times that's going to be a 22+% tax rate. Okay. So this is a strategy that often gets turned backwards. It's non-retirement accounts first, right? Where you aren't essentially pulling out assets that get treated as income. Then it's traditional, then it's Roth. And we can go back to what we talked about before. If you were using non-retirement assets first, and let's say you had a stash of savings or some assets that sat in a brokerage account, your income would be artificially low in that scenario. And that's where you could start making those considerations of moving money from traditional to Roth. Okay. So we're going to end with a little bit of tax planning. So why would someone consider moving money to Roth? Why? Well, specifically for federal employees, right? You guys have a withdrawal from your TSP. And again, it's not specific. Everybody has to make a withdrawal from their employer sponsored plan that's pre tax, whether it's a 401k, IRA, or TSP, right? But the issue with a federal employee is that you guys have more money in your TSPs than ever before. Okay. Back in the 80s and 90s, I can tell you for a fact the TSPs were way smaller. My grandfather was a federal employee. He retired on CSRS. In fact, he had next to nothing in his TSP. Why? Because he retired with like 80% of his paycheck. He was good, right? But he didn't fund the TSP hardly at all because he didn't get a match on that. But first employees are having some of the strongest numbers out of their TSPs on record. There's more $1 million TSPs than ever. So what's happening is you all are participating in a required distribution that the IRS sets forward every single year. And that amount is essentially a percentage of your TSP that has to come out. And that percentage gets larger every year. So why is that problematic for federal employees? Because you all have a pension. So imagine a private sector. Imagine if I have a 5 million, sorry, $1 million retirement plan. And I am asked to take out, let's call it close to 5% of my balance. That's 50K, right? That's fine for me. I don't have a pension. I need that type of money probably out of my retirement plan anyway. But when it comes to a federal employee that may have a 40 or $50,000 pension, and they asked or not asked, forced to take that money out and sit that on top of their pension income and their Social Security income, it oftentimes causes problems. I'm going to talk to you about those problems, but those are tax problems. The account that does not participate in a required distribution is the Roth plan. So that is the key secret of why that strategy that I just showed you or just talked about a couple times, moving money from traditional Roth really can be a great strategy in retirement or even before retirement, considering the tax rates are lower and scheduled to go up. Let's talk about this. Let's look at this scenario here. So imagine if this is you. You guys are, retired. You're a couple. You make your first mistake and draw Social Security early. Okay. So Social Security is up on here. It's, being accounted for, and you have your pension. Okay, so what you basically have in this case is your adjusted gross income is a little bit over 90,000. But are you paying taxes on that? No, because what you have is you have your deductions. You can itemize or you can take the standard. In this case, the standard's being used. So the taxable income in this case is 66,000. That's going to put this hypothetical couple right into the 12% federal tax bracket. But understand that $17,000 more of income will put them in a higher bracket. So let's kind of look at how this plays out, right? If we have a couple, right, and they have $66,000, and let's say they have $500,000 in their TSP, and that TSP, let's say, grows by 3%. Let's say they're withdrawing 1 or 2% during retirement, okay? And they're getting only a 3% growth. By age 73, they're going to have more money in their TSP, and they're going to have this distribution. That RMD is now going to be added to their other taxable income, and that is going to create that higher tax rate. Okay. That is going to basically put them into that 22% bracket. And the downside of that is not only their RMD will catch a higher tax rate, right? But also any accounts that are capital gains, they're short term, not long term, interest, dividends, any investments outside of the TSP that rate those are going to now be taxed at the higher tax rate as well. So this is a scenario that is happening time and time again, federal employees that are in their 70s, and they have no concept or even thought about the fact that this would be a negative kind of outcome for them or that they could do anything about it. So when we talk about Roths, right, there's two ways that you can get money to Roth. You can get money through a Roth contribution, right? You can do that in your TSP, or you could do that to an outside Roth IRA, but there's income limitations on contributions. So there are income limitations, and that's like somewhere around 200K for joint, a little under that for single. Okay, it's about 150 for single. If you're under that, you can make that contribution. What is a Roth conversion? I like to point these out because the language is different. A Roth conversion is not a contribution of new monies to Roth. It's a movement of monies that existed in a retirement plan that was traditional, right? Traditional, which meant that it was pre-tax and it was moved into a Roth. And in that scenario, you would be taxed at your ordinary income tax rate when you moved it. Is there a limitation? No. Is there a income limitation? No. Can you move as much as you want? Yes. Would you want to move a huge chunk over from traditional to Roth? No, because that would put you in a higher tax bracket. Remember, that movement is treated as income. So if you do 100 or 200,000 in 1 year, that's going to be added to the rest of your income. So you're going to pay a higher tax rate. So there's a strategy to do this properly and strategically, right? And there's also a wrong way to do it. The other thing to know is through the TSP, you cannot do that movement until 59 and a half years old. So 59 and a half is when you can do that movement. So here is a example. Lots of things on this chart, but I did want to show you how this works. Okay. So imagine if you had that $500,000 TSP, like the example we had, and imagine you knew that you had a threshold in your tax bracket of 17,000 and you were going to go into a higher tax rate later. Well, you would be silly not to move that 17,000 over to Roth at 12% because you know you're going to pay 22 later. So as you move that 17,000 to Roth, what eventually happens in the future, right, is the balance of your traditional plan has been lowered because you distributed out to Roth. And in turn, the distribution now is lower because it's a percentage of what's in the traditional plan at 73. So in this case, this example, we've created an RMD that fits within that person's tax bracket in retirement. They don't have a negative, uh-oh, bet you didn't see this was coming. They now foresaw this, they did something about it, and they've kept themselves in that same tax bracket throughout retirement by utilizing this strategy. And lastly, they have a balance now in their Roth that's completely tax-free, that has no RMD, that can transfer to their spouse tax-free, that can transfer to their children tax-free. And oh, by the way, you know, if you have a big required distribution and you have a hard time fitting that in your tax bracket, let's say you have a $50,000 required distribution and you have a hard time fitting that in a joint tax bracket, and you pass away, how do you think your spouse is going to fit a $50,000 distribution? Because they're inheriting your retirement plan. How are they going to fit that within a single bracket? Because the joint bracket is gone after one person passes away. A single person would be left. You would have a single bracket with that same $50,000 distribution. No doubt in that scenario, higher taxes occurring. Okay. And of course, higher tax may be occurring for your children inheriting these plans because they'll be in the middle of their working career. So this is really a strategy, not just for yourself, it's also for spouses, children. So you might be saying, well, Neil, do I wait to do this strategy until I retire? Because that's sure as heck what kind of I saw on the slide. The answer is no, because we're sitting in actually reduce tax rates now. I mean, look at the tax rates, right? We have, just look at the joint bracket from 202 to 383 of income. Look how small that range was prior to 2018. The tax rates themselves are lower too, right? So we think now is still a good time to consider looking at this option, because a lot of times the window in retirement to do those, yeah, you might have this window. If you're delaying Social Security to 70, you might have an even a little bit bigger window, but it's really a small window. And you may not get much done in time in that scenario. So it's really something to look at now, really utilize these tax rates to your benefit before they potentially expire, which would be in 2026. So one last thing for retirees to know is everything we just talked about of RMDs increasing your tax bracket is also true for Medicare premiums. A lot of folks can get Medicare Part B in addition to their FEHB. It's because it becomes primary, they got wraparound coverage. And what happens is Medicare premiums are based on income. So when those RMDs come out, that can put you in a higher Medicare premium and cause those issues. It's done this many times to clients that we look at. So lastly, all of these things are, some of them are more basic, but some of them are more higher level. And if these issues are issues that you're concerned about, this is your opportunity to engage in a one-on-one discussion with someone, an advisor from our office. We go over all of the things that we talked about today. Should you be using your Roth TSP? Is a TSP allocation right? When should you take your social? Is delaying until 70 so you have that Roth conversion window larger even something that you should be considering, right? When should you retire? Should you add Medicare to FEHB? What are you choosing in FEGLI? Do you have too much option B? These are all things that can be discussed. If you're interested in that, it's complimentary. We make our calendar available for about 3 weeks after these presentations for you to come in and do these one-on-ones. After that, we're booked up for about several months with our other clients. So if you are interested in doing this session, I would encourage you to sign up by using the link below. You can go right to our website, which is retfed.com/register, /register. Or if you have your mobile phone and want to take a picture of that QR code, that registration's on there as well. So again, thank you so much for the time today. I'll just leave you with just a little bit about financial advisors. When you're looking for one, check on brokercheck.finra.org. Look to see if this person is regulated by FINRA. That's the highest kind of compliance level. Two, if they're giving you investment advice, look to see if this person is a registered investment advisor. If they're not and they're giving you investment advice, they're doing it for a commission on each transaction. They cannot give you a flat cost, and they therefore cannot give you fiduciary advice. So again, that's RIA, registered investment advisor. Check for certifications. CFP is a great one amongst others. That will have a fiduciary conduct as well. And lastly, federal employee knowledge. I can't stress that enough. So many folks come in as private sector financial advisors. They're not paying attention to how all these things affect taxes, things down the line. They just don't have that kind of mindset to those areas. And I think it's very important that you have an advisor that's looking at those areas and how you're impacted by them. So again, thank you so much for coming in. I know we've got questions. I will be taking those now. Feel free to add any more questions that you guys have. I'll be looking into my microphone issue because this is the microphone I was supposed to be using, guys. It's a good one. And I was really sad that I wasn't able to use it when you all told me you couldn't hear me. So there's that. All right. So let's go down and get your questions answered. Cool. So the first question that I have after all of the comments about not hearing me is, what if you don't get pension until 62, but retire before 62 with 20 years? I guess, Gina, the question is, what if? I don't know. It's kind of like an open-ended question. What if you don't get the pension until 62, but retire before Oh, I see what you're saying. This was in regards to like COLA and cost of living adjustment. If you retire before 62 and delay the pension until 62, yeah, you would just be without your pension. And of course, there would be no cost of living adjustment in that scenario. You would avoid a penalty in that scenario typically as well, which is a 5% penalty for every year you retire before 62. It's called a deferred retirement or a postponed retirement. But keep in mind, you got to look at your minimum retirement age with 10 years of service. There's a rule around that, which would allow you to either take benefits or not have benefits in retirement, like your health insurance. Question comes in, does the first supplement generally offset the 0.1% if you retire at MRA? It will, but for a short amount of time. You know what I mean? So this person's basically asking about the supplement, which is a great question. The supplement was left out in this scenario. So what the supplement is it is a temporary um, payment that is right around 70% of what your Social Security is at 62. It's given to you in the years that you retire on your minimum retirement age, between your minimum retirement age and 62. So it could be as long as 5 years, or it could be as short as 1 year, right? Because you could get it at 60 or even 61, and get it till have that payment till 62. Um, it it is a temporary thing though. So does it offset the fact that you're getting 10% less of your pension? The answer is really no, because that's forever. And the supplement is just, a temporary kind of getting you by in those early years while you don't have the ability to draw social. Someone said, could you speak to not just FERS, but also foreign service retirement pension? Oh, yeah. So obviously, as USAID, you guys have different calculations of your pension, right? Different calculations of your pension. So this is a more broader presentation, right? But, if someone is, concerned about calculations on um, federal benefits, let's say, I'd be happy to just share a slide with you. Of course, once my system um, brings that out. So we do have a federal benefits U.S. aid, foreign service presentation. And that is where we kind of share this slide. So FSPS, right? 1% versus 1.7%. So essentially, at age 50, with 20 years of service, you're going to get 1.7%. Any additional service beyond 20 years, or if 20 years is not met before voluntary retirement, is a 1% factor. So there you have that slide. And you're right, that probably shouldn't be included in my retirement benefits when I'm doing it for USAID. It's just that that's probably one of the major differences in that whole slide deck, because everything else is kind of just for the general public, general federal employee part there. So thank you for bringing that up. Social Security benefits. If I delay my Social Security till age 70, does my spouse, who is 5 years younger, get 50% spousal benefits at age 65? Yes. If half of yours is greater than their own benefit, then they would be entitled to that benefit. So that is correct. If your spouse really didn't have a strong Social Security on their own, they are entitled to receive 50% of yours if they wait to their full retirement age. So the only thing that I would change about your question is you said age 65. When your spouse turns 65, no, it would be when your spouse just turns 67, most likely full retirement age is really drifting towards 19. If you're born 1960 or later, it's 67. All right. Sarah said, can you say what the 7 companies are in the C fund? So she's asking about the Magnificent Seven that comprise 30% of the C fund now. That's Facebook, Apple, NVIDIA, Amazon, Microsoft, and Tesla. I think I said 7 there. And if I didn't, Netflix might be in that number too. But those are kind of your Magnificent Seven. Michael asks, how about the retirement with confidence part? The strategies for stock and portfolio investment is lost on most and not relevant to folks who are preparing for retirement. Michael, I think this is a scenario where you've got to get your own stuff looked at, right? So if you're attending a presentation like this, it's not resonating, or certain slides aren't really doing it for you. I think we need to find out, well, what is it that you're concerned about, and figure out if we can help you, get a little bit more confident in what you're trying to achieve here. Next question says, if you retire before age 59 and a half, can you touch TSP? Yes, you can. So there's a rule that if you retire with your with your minimum retirement age and 30 years of service, you can touch TSP, right, as early as age 55. That's correct. All right. Meg has a question. I'm 3 years from retirement. Would it be advisable to withdraw some of my TSP G fund assets and move them to an equity index fund for 10-year term? It has a trigger that pays up to 9% guaranteed principal and returns based on performance on the market without being in the market. Yeah, I'm aware of what you're talking about, Peg. So these are structured investments. Structured investments can be bought outside of the TSP that allows you to participate in an index up to a certain amount. So let's give you the example, S&P 500. There's investments right now, they allow you to participate up to a 10% increase in the S&P 500, which is your C fund. But if that index does negative, you don't lose money. So these are structured investments. So essentially what you're trading in this case is you're trading a higher return than 10% for the downside protection, that if the market loses money in that 1 or 1.5 year period, whatever this structured term is for, that you won't lose money. So this is an example of a structured note. And her question was, would it be advisable to withdraw some for that? I would be concerned about withdrawing money that might want to be in your liquid safe bucket, but putting it in something that might tie up your money. You might want to look at just general bonds instead of that, that are liquid and also pay income and have higher interest rates really than we've seen in the last decade, than putting what was supposed to be your G fund in that. Now, if you're scared about the stock market and want to use that for some of your seed fund, that might make sense. So I got a question. It would be difficult to withdraw TSP if it includes a mixture of Roth and traditional funds. What do you recommend in terms of the best time to withdraw cash from TSP if you want to leave as much Roth money as possible behind in TSP? So understand that now the TSP gives you the control to withdraw from traditional or withdraw from Roth. So that used to be a problem. The TSP didn't give you that ability. With the latest website changes, it now gives you the ability to toggle between those two. So that's the strategy. Please provide additional information on non-retirement versus retirement funds. Great question. All right. So retirement funds are either going to be traditional or Roth, similar to your TSP or an IRA. Traditional funds, traditional retirement plans like your TSP, you funded through your paycheck, but you've never paid taxes on it. So when you withdraw those monies, right, you're going to pay taxes in retirement. Let's say that you have additional money that comes out of your paycheck, but it goes into, let's say, your bank account. Well, you've been taxed on that money, right? Because it actually landed in your bank account. It didn't go to your traditional TSP. Now this is considered, if it goes into your bank, non-retirement funds. It's not in a retirement account. If you go invest that money, let's say in the S&P 500, similar to your C fund, all right, and you make 20% in that account, you're not going to pay income taxes when you invest money outside of the TSP in a non-retirement account. You're going to pay capital gains. Capital gains are usually taxed at a 15% flat tax treatment, and don't affect income taxes. So that's the difference. When you withdraw from a retirement plan, you're paying income taxes. When you withdraw from a non-retirement plan, because you've already paid your income taxes to get that money there, you're just paying capital gains on the appreciation or the gain that you had by investing that money. Okay. All right. Lydia says, hi, would it please clarify my understanding? My RMD for my TSP would put me into the next tax bracket, but I instead move it to Roth account. That money gets taxed at the lower tax bracket? Oh, great question. All right, so number one, let's at least address one thing that might have come up from this question. When your RMDs begin at age 73, can you take that RMD and instead of just being taxed and putting that to your bank account, can you put that in another retirement plan like a Roth? The answer is no. So that's the downside, right? At 73, you kind of lose control of your TSP. You're being forced to take out that money. You're being taxed on that money, and that money can now not go into a Roth plan. So that money has to be invested in a non-retirement plan. Now, again, that non-retirement plan will tax you, or a non-retirement account will tax you on dividends, interest you earn, and capital appreciation that you earn, capital gains. Whereas, had you have taken out money prior to your RMD and sent it to Roth, you would have been taxed on it, sure, but that money would go into a Roth plan, which would never tax you on dividends, interest, or capital gains. So you see the difference? Your RMD, once that begins, brings money outside of retirement plans into non-retirement that tax you on dividends, interest, capital gains. Whereas prior to that, if you made those movements into a Roth, which are the same movements you're going to make in the future, you're getting the advantage of sticking that towards a tax-free account for the rest of your life that doesn't have an RMD and literally can be kept there indefinitely. Someone asks, can I convert to Roth when I retire to capture lower tax rate versus conversion now while still working? Yeah, you can. Yep. That may be advantageous to you, but it may not make a big difference because the window that you have there might be too small. So the question is now when you're in lower tax rates because of tax rates being lower, a better time to start looking at conversion early. And then in addition to that, be looking at some conversions in retirement. The answer is you won't know until you look at that. And that's what going through a retirement analysis is all about, is actually seeing how all these things stack up. How much time do you have in retirement? Are there other factors at play that might, derail you from being able to do that then, right? Okay. Someone asked 529 leftover funds to Roth conversion for children. Does Maryland charge state taxes on this conversion? Um, So this is a question about, okay, so everybody, just so they know, starting in 2024, if you have up to $35,000 left over in a college 529 plan for a child that was never used, and that money has been there for 15 years, it's got to be there for 15 years, that money can be rolled into a Roth now. That's a great new rule. And from my understanding, it's brand new. So we haven't done this for anybody just yet. There are no taxes on that conversion. Okay. All right. So we've got a lot of feedback. Oh my gosh, thank you so much for putting that. And even better, guys, we have a survey at the end of this. I would love to get your feedback on that survey because we also give that feedback to your administrators that host that put these on for you, and they need to hear this feedback. So thank you so much for your feedback. Um, Looks like we have just a couple other questions. One says, what's the best fund to use in our TSP? Well, it's been the C fund, but I don't have a crystal ball. I'm reluctant to tell you the C fund's going to be as strong as it was, but I'm also reluctant to tell you that that's still not going to be the best fund moving forward. So I've got to go with what has been paying kind of the bills, and that's the C fund. I mean, the C fund has been the big earner of your TSP for a decade. Now, again, there's some concerns around it, but I still wouldn't tell you not to use it and not to use it fairly strongly in your TSP. Next question is, can you delay pension and still get your benefits? Um, it's only if you retired with your minimum retirement age and 10 years of service that you could leave, to delay your pension, get your pension back at 62, and pick your health insurance up. Is that what you're asking? Because if that's what you're asking, then you would need minimum retirement age. So pretty much 57. You'd have to get to work till 57 and have at least 10 years of service to do what you're asking, Gina. Angela asked, can one of the sessions be virtual or do we have to come into your office? Oh, great question, Angela. None of our meetings anymore are in person. So you don't have to come to the Chevy Chase office, which is a pain in the butt. The garage parking there is awful. And honestly, we work virtually so much that the virtual appointment is going to be what we're going to end up doing for you, at least for your first couple appointments. Okay. All right, Gina. Okay, I'm 40. Okay. Um, Howard says, what is the foreign service multiplier factor 1.7, even with less 20 years if I retired under MRA? What is the foreign service multiplier factor? 1.7? No, it's 1% from my knowledge, Howard. If you do not get your minimum retirement age, you're going to have that factor be reduced. And I'll put that on the board again. So any additional services beyond 20 years, or if 20 years is not met before voluntary retirement, it would be 1%. Okay. Now, so from my understanding, the way the rules are met, right, 1.7 is only available with age 50 and 20 years of service. Now, obviously, if there was like a fourth termination or something like that, there could be some other rules that apply, but that's what That's what I understand of that foreign service metric. All righty. Well, I will take a couple more questions, but beyond that, I do have another obligation I have to get to. So let's talk about all of our money for retirement savings are pre-tax, and retirement for me is May 31st. And for my wife, a year or so after that. Is there any particular strategy that might save taxes for us, or is it probably too late? No, I mean, you should do an analysis. In our analysis, we take your tax return, we look at the whole picture, and that's where we give you a whole outlook, year by year outlook. And when's the most strategic time to start addressing some of those tax concerns like conversions to Roth and things like that. So I would highly encourage you to do that, Dennis, with your scenario. Um, Next question comes from one last one I'll take. Uh, let's see. Should I draw my widow benefits at age 60 and delay mine because my Social Security benefits will be higher than my spouse? This is from Denise. Yes and no. So basically, what Denise is asking is she's asking about Social Security survivor benefits. So when you're in a survivor benefits scenario where your spouse has passed away, you are entitled to get up to 100% of your deceased spouse's benefit. But that would be at 67. You are eligible to start your deceased spouse's benefit as early as 60, but that would be 70% of their benefit. Yes, you would do that at age 60 and collect 70% rather than wait, because what you're going to do is you're going to turn on your own benefit at 70 and maximize and let that thing grow as big as possible, like you're saying. However, keep in mind there's an earnings limitation to drawing Social Security, whether it's spousal, whether it's survivor, or whether it's your own, prior to your full retirement age, which is typically 67. So if you're still working at 60 and earning income, you won't get that survivor benefit in that scenario. Um, if you make over about 20K, you lose $1 for every $2 that you're over that amount, and very quickly that amount is gone. So yeah, I wouldn't do that if you're still working. All right, guys. Listen, there's some more questions on here, and I hate to cut it short, but it's 20 minutes after. You guys had awesome questions. If we didn't answer those today, I recommend that you guys come in for that one-on-one. That's a great place to get those questions addressed. We will make sure that every single one of your questions are addressed during that scenario, and it is a complimentary session. So you really don't have anything to lose in that scenario. So again, uh, um, you know, have a wonderful rest of your work week. Look forward to working with you guys in the future, and hopefully you guys learn some new things from today's session. Please tune in to some future sessions. Please go ahead and fill out that survey questionnaire at the end of this. Very helpful. It gives great feedback to not only us, but to your benefits folks as well on how these sessions are received. So take care and enjoy the rest of your workday.